Hello, Henry Becker here with Lighthouse Wealth Management, Director of Research and Investment Strategy. As you know, we're trying to keep up with modern technology and producing monthly videos. So for this installment, we are going to cover the markets and their recent volatility and the global economy. Over the last several months, there have been a lot of talk in the media about bear markets and recessions. Now keep in mind, the most widely accepted definition of a bear market is a 20% drop from the most recent high to the low. If you take a look at this first chart, you'll see that while the S&P 500 has not dropped 20% from its highs, many other areas are already in a bear market, meaning the subsectors of the S&P 500, like biotech, transports, technology, financial services, and so forth. And also, the U.S. small cap index, Russell 2000, is down nearly 20% as well. As we've discussed before, at the heart of the recent downside volatility is a weakening global economy, a rising U.S. dollar, collapse in oil prices, and then the recent decision by the Federal Reserve to raise interest rates. Here in Chart 2, we're showing a history of S&P 500 bull and bear markets. Now, these are long-term movements. And there's been 8 bear markets that have lasted an average of 15 months since 1926. With an average loss in those bear markets of 41%. Now at this time, we don't particularly think that the S&P will drop by 41% peak to trough, but we do think that it might not be that we've seen the bottom yet in this most recent downside. It's important to keep in mind that a recession is, technically speaking, 2 negative back-to-back quarters of GDP growth. Now, we have not seen that currently in the United States, but there are parts of the world that are in recession, and that number seems to be growing. And if that trend continues, we could see the United States slip into recession. But also keep in mind that recessions aren't the worst thing that can happen in an economy. Actually, quite frankly, there is a benefit. And the benefit is recessions tend to be a cleansing environment in the sense that malinvestment or poor investments or over-indebtedness tends to get resolved during recessionary periods. So all told, we don't really see great risk-reward opportunities right now. We quite frankly see more risk than reward in the investing markets. And to that end, we've increased cash in client portfolios, specifically our model portfolios. We've increased cash by selling equities, and we started doing that about August of 2015. So as I speak in this video, we have a fair amount of cash in client portfolios. And we don't necessarily want to have cash in client portfolios, but in the current zero interest rate environment and some of the things in the investment world being turned inside out, we see cash as a great parking place while we wait for better risk-reward opportunities, which we think might be in the not too distant future. So with that said, if you have any questions, issues, concerns, feel free obviously to reach out to me. I'd be happy to answer any questions that you might have.